You have just entered the other 1%. Stop working for money. Have money work for you. We will go over a couple of key events that are happening this week, particularly the Nvidia earnings call on Wednesday the 28th, right after the bell. There are some great opportunities coming up with this Nvidia earnings call, but you got to know how to protect yourself in order to make the right plays and all the various options that you have, and specifically options, because that's what we're going to be going over today. We're going to go over some high risk and some low risk plays. Let's jump right into the chart. We got the chart pulled up right here, so you can see Nvidia has just almost reached an all-time high. Once again, we had a little bit of that pullback that we saw during the Black Monday event that everyone was freaking out about. It really wasn't that big of a deal. We lost about 2.5% probably across the major indexes, and they jumped right back up as expected. A nice quick little dump, a nice quick little pump. We like to dump, we like to pump. It's all pumped up right here, baby, you know? Right now we're trading a little bit sideways in anticipation for this earnings call on the 28th, on Wednesday, and that's going to be after the bell. So we're going to actually see the results on Thursday. How are you going to capitalize on this? There are a couple of different ways that you can do it, and I'm going to outline a few of the option strategies that you can implement in order to succeed on this trade, and other ones that I'm going to show you are extremely high risk and you should probably avoid. I would not recommend doing any of these. All right, first of all, let's take a look at the last times that we had earnings calls from Nvidia and what the reaction was for the underlying stock. You can see here on May 22nd, there was a jump immediately of about 10%. And the time before, we had a jump of about, 15 to 16%. I mean, those are major jumps. When you get earnings calls, typically what ends up happening is you get a swing one direction or the other. Now, Nvidia has outperformed continually, and that's why we see moves to the upside and not to the downside. However, you have to be aware that even with a beat, even with an earnings beat of Nvidia, we can always expect to have a downside, because if it doesn't exceed the expectations more than it was already anticipated to exceed, you actually have a pullback and a lot of selling off. So with that being said, many people will just strictly buy calls or buy puts in anticipation that the stock will go up after the earnings or go down after the earnings. But I'm not really a big fan of that play because you're so reliant on the direction, and that can be a little bit dangerous. You can lose your entire lot in just one earnings call. So let's jump over to the trades that I have set up for this particular earnings call. All right, so what we're looking at here is a graph that outlines the play of an option strategy over a certain period of time. On the x-axis, you have the price of the underlying stock, in this case, which would be Nvidia. And on the vertical axis, on the y-axis, you have the profitability going from negative all the way on the bottom to positive all the way on the top. We're able to move the sliding scale right here over time to see exactly where this will end up over a certain period of time. This particular trade that I've set up is one of my favorites. It's called the Iron Condor, where you have two sets of credit spreads. The idea behind this trade is that the underlying stock, in this case Nvidia, will stay within a certain range. In this case, we will maintain profitability between 103 and 147. So if the underlying stock, Nvidia, stays between those two red bars, we will maintain profitability. The key to this strategy is understanding that you actually want Nvidia to stay in a certain range. When there's an earnings call, we have a pretty big jump. So this trade might not be that valuable to us. If we move ahead a few days, we're not going to get much action here. The best case scenario is going to be $7. Worst case scenario is it shoots up and we're losing hundreds of dollars, which is not what we want. So I don't really like this trade for an earnings call. Boom. So this is a trade that I actually prefer for the earnings call on Nvidia. This is actually the opposite of the play that we just discussed. This is the inverse Iron Condor. So it's backwards. It is actually a debit spread instead of a credit spread. The way that we have it set up here is September 6th expiration, and we have it spread out 105 put, 110 put, 145 call, and 150 call. The basis behind this trade strategy is as time passes, when we get that earnings call, we're going to set the time to about Thursday morning when the markets open after we've gotten the reading from the Nvidia call. If all else is the same, we have a 30% risk if it stays exactly where it is right now. If Nvidia shoots up like it normally does, somewhere between 10 and say 20%, we're looking at a pretty nice chunk right there for a low risk. The only caveat to this strategy is that after an earnings call, you have what is called IV crush, implied volatility crush. This means that the implied volatility will actually go down after the earning is released because there's not any question of what will happen. We've gotten the result and we know what the earnings results are. This tool allows us to change the predicted implied volatility over that period of time. So let's say that we contract an implied volatility and we get an IV crush and we lose about 22% of that. That actually hurts our position, which is an unfortunate aspect to this trade. However, we would have to stay within this range of 114 and 140 for it to be in the negative zone. If it jumps a tremendous amount, which it usually does during earnings, we still have a lot of profitability zone, maybe even get into the $100 range winning potential, whether it goes up or down. And that is the beauty of this trade. It's not directional. And that allows us to be correct whether the earnings are bad or whether they are good. The strategy is to have the underlying stock go down or up in price by a whole lot. A monstrous movement. That's what we want. A big old fatty, a chunk of movement one way or the other. All right. This is a strategy now, a long call, straight up buying the 120 call in anticipation that Nvidia will go up in price. Most Wall Street bettors will do this exact trade, and most Wall Street bettors will lose. While it is anticipated that most likely Nvidia will jump from this earnings call, it is still a risky proposition, and here's why. If for some reason Nvidia would stay flat or even go down by 10% if there was a poor earnings report, you'd be looking at almost $1,000 loss if it went to the downside, unlike the inverse iron condor that actually would be profitable if the stock went down by a large margin. Yes, the upside potential is juicy. There's no question about it. If Nvidia were to jump 18%, you would be raking in over $1,000, $1,800 in this case, which would be delicious. I mean, a tasty burger for sure. But is that worth $1,000 risk? I guess that's a question you have to ask yourself. When trading options, those are the questions that you need to ask. Am I willing to take on this kind of risk? But the ultimate risk in trading options is the next trade that I'm going to introduce to you. All right, so I would consider this one of the most dangerous and high risk option plays that you can have. It's called the short call. And the reason this option is so dangerous is because there's actually an infinite maximum loss. If the stock were to go up to an undefined amount, into the thousands in this case, your max loss could theoretically be infinite, blowing up your entire account. We're talking about going back to Wendy's and working behind the dumpster. Forget about it. It's over. It's blown up. So if you look at this trade, it might actually seem pretty promising. Over a period of time, if you move the slider here forward, you're going to end up in a position where even if the stock rises 5%, you're still in profitability zone. If it goes down in this case, you're actually going to be ultimately profitable and you can get about $600 in profit if it goes way down. But let me just slide open the range here and show you the potential devastation that your account can experience if you screw around with this one. If Nvidia were to blow off the top and jump by 50, 60, 70%, whatever it might be, while unlikely, you never know, especially with these Magnificent Seven stocks, these things go up and fluctuate like crazy, and there doesn't seem to be an end to where these can go. You're looking at thousands and thousands of dollars in loss. While yes, it's actually a pretty decent probability that you win this trade, it is extremely risky. There's a high probability that you end up scraping gum off of sidewalks for the rest of your life to repay the debt that you owe to your broker. Trading options is all about risk tolerance. As we saw in the previous examples, you can take defined risk trades like the condors that we discuss, or even the long call that all the Wall Street bettors will be placing in the next few days. At least you know you have a maximum loss. With naked options, they're exactly as they sound. You end up naked on the streets, working for the man and never getting out of it. So I opened these trades earlier this morning and I'm going to leave them there and we're going to find out together exactly which strategy worked the best after this earnings call. That way we can determine in the future what our best course of action will be in order to continue to maintain, grow, and reproduce our money in a valuable and safe way. Depending on your risk tolerance, you can apply any which one of the strategies we just went over to this Nvidia's earning call and potentially be successful, or potentially be laughed at when you need to drink hobo sock juice in order to get your hydration for the day. The main takeaway is to avoid undefined risks in short calls and short put options. These naked options will leave you exposed. Hence the name, naked. Do you want to have your parts put out there for display? No, you got to at least blur it out like they do in Japan. The Japanese understand defined risks. So where do you think Nvidia is going to go after this earnings call? Stick around throughout the rest of the week. We're going to monitor these plays that we've set up today on Monday and see how they end up on Thursday after the earnings call and which strategy is the best to implement. Subscribe, get the bell, or you're not going to know what's happening. You're going to lose all your money. You're going to end up being naked. No, but seriously, don't end up picking the crumbs up. Build your empire of wealth around you. At the other 1%, we will learn various tactics that we can use in order to be successful and stay successful and grow our wealth so we don't have to work for money. Money will work for us. We'll see you tomorrow. So long.